What are stocks? You've probably heard people talk about stocks or the stock market. Maybe you know it has something to do with money or investing. But what are stocks really? Let's break it down simply. A stock or share is a tiny piece of ownership in a company. When you buy a stock, you become a part owner of that business. For example, if a company has 1 million shares and you buy one share, you own 1 millionth of that company. Companies sell stocks to raise money. This is called an IPO, or initial public offering. Instead of borrowing from a bank, which requires repayment plus interest, they sell ownership slices to investors. The company uses that money to grow, hiring people, building products, or expanding. Investors get ownership, hoping the company becomes more valuable. So how do you make money from stocks? There are two main ways. First, price appreciation. If you buy a stock at $10 and later sell it for $15, you earn $5 per share. Stock prices change based on supply, demand, and how well the company performs. Second, dividends. Some companies share profits with owners via cash payments, like 50 cents per share quarterly. But not all companies pay dividends. Younger ones often reinvest profits instead. Of course, stocks aren't without risk. Companies can fail, and stock prices can fall. The market fluctuates daily due to news, economics, or global events. A good rule is to only invest money you won't need for at least 5 years and never risk essentials. If you want to start, you buy stocks through a brokerage. Online apps like Fidelity, Schwab, or Robinhood. Research companies you understand. Many beginners start with ETFs, which are baskets of stocks, to spread risk. And a tip: focus on learning, not getting rich fast. Quick recap. 1. Stocks mean ownership in a company. 2. Companies sell stock to fund growth. 3. Investors profit if stock prices rise or via dividends. 4. Risk exists. Invest wisely.